right, hey everybody. Welcome to another Steady Wealth podcast. Serge Berger here, this time coming at you from the Newark International Airport, or as I like to call it sometimes, my home away from home. If anyone's ever been to this airport, you know how much of a situation it can be. I have struggled. I've had the fortune of struggling through this airport for the past, I'm going to say 30 plus years. I've seen it, in really dark places, and it looks to be getting a bit better, and I'm hopeful. Anyway, jokes and side chatter aside, let us talk about something really important today. If you've been listening to our podcast for a number of months, even if you're just tuning in today for the first time, you have heard or will now hear me reiterate the important rotation that's taking place in the market. We're very fortunate last week to meet with Eric from Simplified Funds, Simplified ETFs, and he and I had a great chat about the importance of considering ETFs from a portfolio strategy perspective, and how we can make things simpler, no pun intended, to kind of navigate the markets through that lens. It very much ties in with today's discussion. Again, this is a continuation of essentially something we've been hinting at and talking about now for probably, I'm gonna say at least 4 to maybe 6 months, and even did a special webinar for some clients last week, Sunday, 2 weeks ago on Sunday, I should say, by the time you're watching this, on this big rotation that's taking place. If you are interested in getting access to that special discussion, that's typically only available for people behind the paywall, but you can email us, support@thesteadytrader.com, and we're happy to send that to you. So let's talk about that though for now, and what this is all about. Again, if you've been listening to us for a while, you know this, but let's start kind of from the beginning. So if we look at the market, I think everyone by now is aware of this, that technology stocks have had a big run. They are dramatically overweight, historically speaking. I have some supporting documentation that I will share with you here. As always, I'm going to make sure that if you're watching this on YouTube, of course, you'll see the charts. If you're watching through a traditional YouTube podcast channel, you won't see the charts, but you won't miss out a thing because I'm going to share it with you here, visually appealing. So let's talk about this a little bit, and then I want to show you some opportunities that we are seeing right now that are really starting to emerge. Excuse me. I think are really going to be the ones leading us forward. So first things first, and I'm going to now quickly share my screen for those of you that are going to see it. I'll talk to these points here. So again, if you're watching this on traditional YouTube channel, you won't miss out a thing. Essentially, it has to do with the breakdown of market concentration. This is not about technology stocks being so overweight as much as it is also, and more importantly, about understanding why this has taken place and where we think the money is likely going to flow to. Again, we talked about this with Eric last week from Simplified Funds. Please go ahead and listen to that podcast. It'll be 20, 25 minutes, very, very well worth spent your time on. Maybe listen to it in the evening before you go to bed, or instead of watching TV. And the market concentration in technology stocks is at a record. I mean, we're talking about IT, technology sector, the S&P, tickling 30%. If you take into consideration communication services stocks as well, that's another 9 or 10%. You're looking at a roundup of almost 40% of tech, and that's not even including other companies that really are kind of tech companies in other sectors that are disguised as other sector stocks. So we're looking at technology here, essentially, and this is the punchline, being a dramatically, a historically big overweight, not just in the indices, but also in people's portfolios. In fact, it's probably worse in people's portfolios because people tend to be also picking some of their individual stocks. They're long the S&P, then they're trading on their own. And so they're kind of double, triple long, essentially one asset class, one sector, and that is just basically technology. I think there's a better way. Now, let's understand why has technology done so well. Well, a couple of situations. Obviously, with technology, we have evolved over the years, and technology has become, a bigger thing. Then we've had now inflation. Companies, investors have now flocked towards those somewhat reliable, growth stories, Microsoft and some of the other really big ones. And all that has a sort of feeds on itself, and essentially makes the indices extremely overweight in one part of the market. But all of that is really happening, has been happening because of a 30 plus year disinflationary environment where we've had globalization. We've outsourced here in the United States and in Europe. We've outsourced essentially our manufacturing capabilities to China and some other places. Their quality of living has gone up, and ultimately that is now actually tailwind, ironically, for some of the other sectors that we think are going to likely start performing much better and are performing now. So this is more of an update than this is a continuation of what we've been talking about for the past 5 to 6 months. So we really see technology here basically no longer being the leader in terms of the sector performance. That's not to say that these companies are going to collapse, fall apart, become horrible investments. They might well stay, and track along with the broader indices, but I think the broader indices might actually go sideways, and that's the punchline. So from an investor's perspective, if we are indeed in a higher inflationary environment, we need to understand what that means. In fact, if we just go back not very far, we can see that over years, the technology sector, for example, wasn't always almost 40% of the S&P, or 30% if it's just the actual technology sector, which again is not true because there's a lot more tech in the S&P than just the technology sector. But for example, in 1999, just before the tech bubble burst in April of the year 2000, I know it well. I was trying to go on Wall Street, had a couple of job offers from big Wall Street banks. They rescinded those offers, and I ended up was fortunate enough to go work for Bloomberg, where I learned lots of skills, and then back to Wall Street. But at that point, technology was at almost 30% of the S&P 500. We're now there. And that's not to say that this is the same period now as we had back then. There are differences. These companies that are in tech now are much more profitable and so on and so forth. I get that. My point, and more so, is that in the past, not always has tech been a 30% weighting the S&P. In fact, sometimes it was as little as 7 or 8%. Medium is probably closer to 15%. So that means that as a base case here, if we remain in a higher inflationary environment, it is entirely possible that over the course of the next 5 to 10 years, technology starts to become less of a weight in the S&P, passing the baton onto other sectors. What kind of sectors? Well, for example, real assets. Real assets. That would be something like silver or stocks or gold, let's say, or stocks related to that, be that maybe gold mining stocks. I keep talking to our clients about Freeport-McMoRan, which is probably my highest conviction. I hate to use the word conviction, but the trade I like most from a single name perspective through the lens of multiple years, because of the crazy demand for copper, and that we're likely going to see. And so real assets like that, but also companies that are paying a cash flow now, right? ExxonMobil, Procter & Gamble. So you now look at energy stocks, which, by the way, right now, energy stocks are making up, let me see this quickly. Energy stocks right now, currently as I'm recording, they're making up about 4% of the S&P. Historically speaking, energy is probably closer to at least double that, somewhere between 8 and 10%. So you can see where technology could start to give up some of its market capitalization share to other sectors. So from a sector rotation perspective, we think it's extremely prudent here to start considering. Remember, none of this here is financial advice or investment advice. It's purely educational purposes here, this podcast. But we think it's extremely prudent to start considering making shifts in a portfolio. This is one of those things we talk about all day long to our clients who run the publishing company at the Steady Trader, but also over at Blue Marlin Advisors, our investment advisory firm, where we manage portfolios and give advice. Let's look at a couple of things to give you an idea of this. So, we've talked about ExxonMobil for a long time. This is one of those, again, what I consider to be real asset stocks. They pay a cash flow. Right now, they have cash flow. They pay a dividend. They make money now. They are, and arguably Google and some others have recently announced dividends. That's good. And by the way, I don't think that's coincidental. I think they realize that if we remain in a higher inflationary environment, and I'm not talking about 10% runaway inflation, I'm talking about, 3 to 4% inflation, which is basically, 50 to 100% above the 2% threshold of the Fed and the longer term target of, let's call it, 2.5% or so. In that environment, real assets are going to do better. And also companies that pay a net cash flow now. Why? Because if we invest in a technology company that reinvests its earnings for future growth, the investor does not have anything in their pocket in terms of a real dividend or special distribution if the company reinvests their money, right? There's no throwing off of any cash to the investor. And so those cash flows at a higher interest rate of the future cash flows that are not being paid out are worth less to the investor now, to the investor in the future. So investor now. So what needs to happen is people want their money now, not in the future when it's worth less. So if a company has a high dividend and decent growth, ExxonMobil, in my opinion, a tremendous idea. People are getting that money now, not when it's worth less in the future. So at a higher discount rate, right, the net present value from that perspective is less. So companies that are promising to pay something in the future, like a big tech company, those cash flows, those potential cash flows in the future get discounted to the present. So long story short, real assets like gold or stocks paying cash and actually having earnings like ExxonMobil. Speaking of gold, let's look at some of these commodities. So gold, again, we'll look at the GLD here for those people that are not seeing the chart. We called that breakout back in February. I started really getting long gold last October. This is not at all a high-fiving myself, just for full disclosure and transparency purpose. I've been talking about this all year because we really thought that we were going to get into this environment where gold could shine as it starts to become an asset that people value as a protection of against inflation if inflation doesn't go away overnight. And that appears to be the case right now. So gold continues to do really well. So that's the kind of stuff we want to have in a portfolio going forward. It's counterintuitive. Gold does not pay a dividend. I get that, but it holds its weight against inflation. So it's a hedge, but it can also do really well if it starts to chase, if people are buying it, central banks are buying it, so on and so forth. Copper, there are ETFs for all these things, by the way. So gold is GLD, copper is CPER, which we've been adding to some of our newsletter portfolios over the past few months. It's, again, one of my highest conviction longs over the long term. It's getting a bit long in the tooth right now, to be quite frank. And then, one way to be long copper is also to basically be long a stock like Freeport-McMoRan, which I hinted at before, a ticker symbol FCX. And again, companies that are paying now that actually have real earnings, not some dystopian promise in the future of making money when inflation might inflate away those earnings, right? We don't want that, and investors likely don't want that. So this is a topic that we're going to continue to talk about unless something totally changes and this falls apart. We think this is going to continue to play out very well. Let me just quickly one more time hint at or show the chart and talk to the chart of Freeport-McMoRan. For those of you guys seeing it, you can see it. If you can't see it, Freeport-McMoRan, maybe look at a chart yourself. It's just unbelievably bullish if you consider both the backdrop of a basically shortage of copper, the tremendous need we have for it, the fact that it's a real asset, the fact that Freeport-McMoRan is an actual company making money now, not at some point in the future. It kind of all lines up, right? So this is an update on some of these things, and some of these things are really moving now. We're seeing right now copper breaking out, gold breaking out. Energy stocks are making a move. ExxonMobil, we just last week put on some options bullish trades in things like gold and energy via actually ExxonMobil on the energy space. So these things are all moving in the right direction. Meanwhile, technology not doing badly, but if you look at this, if you look at the performance over the past 3 months, we can see that energy is in second place. Material stocks, which is closely related, in sort of third place. Consumer staple stocks, right? How is that? Closely catching up. Financials doing well, and then at some point we get to technology. Technology is not falling off the bandwagon, but they're no longer leading. And that, I think, is just the beginning now. Again, we'll see what NVIDIA brings. Who knows? The stock can rip 20%, fall 20% after earnings. We'll see. But I think a lot of that's going to be noise as opposed to a new leadership market by technology. Over the next few weeks, months, we'll see. We are going to have a tremendous amount of guests here. You saw a bit of a glimpse of that last week with Simplify ETFs. Eric talking strategies last week. I'm really looking forward to some of the other very special guests we have, companies, people that you may have heard of, very, very smart minds in the markets, willing to share their knowledge with our audience. So please stay tuned for these upcoming podcasts. And then we're going to do special webinars as well for people as well to go even more detailed into all this good stuff. Thanks for listening. I'm going to go catch an airplane now. Greetings from the Newark airport. Until next time.